I believe Larry Kotlikoff was the Boston economist you mentioned. He's been very instrumental in kind of arguing that we really need to look at budgets in a kind of intergenerational type of perspective.
Absolutely right.
You know, looking at a budget in any 1 year is kind of meaningless from a long-term perspective. There's actually, in line with that, there's a recent study just a month old by the IMF that finds, you know, this is the most recent estimate of the fiscal gap in the United States, and the conclusion is that a full elimination of the fiscal and generational imbalances would require all taxes in the US to go up and all transfers to be cut immediately and permanently by 35%. A delay in the adjustment makes it more costly. Now, again, it's probably the reality is not going to see that kind of adjustment.
It's a worry. It's a worry.
Now, maybe it's the time for me to give an opportunity to the students to ask Don questions. So feel free to fire away. Charlie?
As a central banker, what do you find in the long run more dangerous? Government restructuring of the debt, or government default, or hyperinflation?
Which is more dangerous, government default or hyperinflation?
Yeah. For example, in Europe, you have the choice of either letting Greece default, or they can just literally inflate the debt away. Obviously,
because Greece can't inflate it away because it's part of the
assuming all the other countries agree with it. But
okay, I think there really are three options, aren't there? One is that Greece leave the European Monetary Union, and then they can presumably inflate some of the debt away, or let the drachma decline in value, or some other way reduce the burden of the debt. Alternatively, they stay with the European Monetary Union and renegotiate their debt. But it's hard to see how else they can do that. I suspect that it's less disruptive to renegotiate the debt than to leave the euro, but it's a tough choice.
In 2008, you gave a speech entitled Big Ideas to Supersize the New Zealand Economy. One of the suggestions you gave was to give the Reserve Bank of New Zealand an additional instrument to modify inflationary pressures, namely a constrained authority to vary the excise tax on fuel. You said that would provide stability of the exchange rate for exporters not provided by the official cash rate. So I have three prongs to this question. Firstly, was that ever implemented? Secondly, do you still believe that it's viable for New Zealand and all the rest of the world? And thirdly, how would a central bank balance the two such tools, being the excise tax variability and the official cash rate, based on the classic economic monetary policy trilemma?
This guy's obviously done a lot of research. You're quite right. That speech is on my website. The proposal was motivated by a concern which the export sector has in New Zealand, and I suspect the export sector has in Australia, that floating currencies fluctuate. And the amplitude of those fluctuations is quite substantial. If you look at the New Zealand dollar, Australia's not quite as bad, but it's not very different. If you look at the New Zealand dollar over the last 20 years, the appreciation from the trough to the peak, the largest appreciation over that 20-year period, on a trade-weighted basis, real terms, was about 50%. And you think that's a heck of a large appreciation to deal with if you're an exporter. Now I looked around the world, and that's characteristic of most floating currencies. In New Zealand, we think it's because we're such a tiny country, small currency, floating all over the place. We can't be expected to cope with that. But the trough to peak appreciation of the yen has been greater than 50% over the last 20 years. US dollar about 20%, Canadian dollar about 50%. So big swings in floating currencies are absolutely normal. So I was looking for ways of reducing the amplitude of those fluctuations by finding something other than the official cash rate to move. Now, the official cash rate isn't the only thing which drives drives the exchange rate, as we all know. But it's one of the things which drives the exchange rate. And I thought, well, is there some instrument we could give the central bank to supplement the official cash rate, not to replace it, just to mean you mightn't have to move it quite as aggressively. And it seemed to me people, Larry Ball in fact suggested varying tax rates generally. And now I think that's totally impractical. I mean, you simply can't kick income tax rates or the GST rate around in practical terms as much as you'd like to with monetary policy. But the excise tax on fuel, you collect from only a very small number of points. The public are accustomed to the price of fuel going up and down like a yo-yo. And because demand for it is inelastic, at least in the short term, the effect on other spending is very similar to the effect of changing interest rates. So I thought it was a useful way of supplementing, not replacing, supplementing the interest rate. Just you wouldn't have to use the interest rate quite as aggressively if you also could vary the excise tax on petrol. No, it was never adopted. Most people just ignored it completely. I think that's a pity because I thought it was not a bad idea, but no one's taken it seriously either in New Zealand or anywhere else.
Yeah, we had a discussion about it when you gave the proposal here, and I expressed some concern regarding economic theory and which side of the market, supply demand, would be implemented and so on. But we can leave it for the time being. Can I invite another question? Cheery?
You mentioned that your inflation target was between 0 and 2%. Personally, what target do you feel most comfortable with? Because as you're heading close to 0%, you play with the possibility of deflation and a liquidity trap. So do you think that it's better to target the higher end of the inflation intervals?
0 to 2 was rationalized by my central bank colleagues as being 1% plus or minus 1. And 1% was chosen because it's the estimate, which is done, I think, in the United States, that a 1% measured increase in the CPI is probably equivalent to genuine price stability. There was a bias in the measurement of the index, not allowing properly for quality changes and so on. So we said 1% genuine price stability plus or minus 1 to allow for variability. That was how we rationalized it. The origin of the number actually is much cruder politically. Inflation, which had been very high in New Zealand, came below 10%. And the then Minister of Finance, Roger Douglas, was asked on television, "Aren't you satisfied now? Inflation rate's only 9." And Roger Douglas apparently said, no, I want price stability, like 0 to 2. And that sort of stuck, even though at the point that he announced that he had done no analysis of the logical correct target at all. Subsequently, we changed it from 0 to 2 to 0 to 3. And the logic for that was that, particularly in a very small country, you get a lot of shocks which have an impact on the CPI, which tend to get smoothed out in a much larger economy. So we said, look, rather than constantly explaining why you're outside this 2 percentage point range, widen the range a bit so that you're not so constantly explaining. Then in 1999, I think it was, the target was changed again to 1 to 3, and that's where it is now, 1 to 3. For the reason I suspect that you mentioned, that when you're getting close to 0, most central banks are going to be keen to avoid getting too close to 0 and be trying to shy away from that. So we said, look, let's recognize reality and choose a target a bit higher than 0. I have to say I'm not totally persuaded by that myself because yes, the 0 bound is an issue for a large economy. For a small economy like New Zealand and indeed like Australia from this point of view, the other thing which can affect monetary conditions is an easing in the exchange rate. And that can have quite a profound impact on monetary conditions. So if you drop the Australian interest rate to 0, say, you'd almost certainly get some reduction in the Aussie dollar. And that would provide some measure of stimulus, which may not be so obviously true in the case of the United States.